Assalamu Alaikum everyone, welcome back to the channel. In today's video we will be looking at the best semiconductor stocks in the S&P 500. Some of these companies I own in my own portfolio. We're going to look at 5 different companies, but before we look at the companies I just want to give you like the backdrop and understand why these companies are very important to us at the moment. Right, so the first thing I want to show you is the business models, because this is really important. I really don't think a lot of people understand this, and it's very important to understand, especially when you're comparing like for like some of these companies. Because I've got a friend who was actually, we're talking about recently the semiconductor companies, and he was comparing like some of these companies, but they are actually not comparable. Like they're not in the same kind of, in the same industry, but they're not really you can't compare it like for like. Basically, that's what I'm trying to say. So the 3 major models, are you've got the integrated device manufacturers. This includes companies like Intel. You've got fabless companies, AMD, Nvidia, and so on. And then you've got foundry models, and this includes Taiwan Semiconductor, for example, TSMC. So 8 IDMs design and manufacture ICs. So they design it first, then they manufacture it. So Intel is one of those companies. Fabless companies focus only on the design side of things. So all they do is just design it, then they give it to companies like the foundry companies to make them for them, basically. So they pay these companies to actually, so they will design it, and then they will pass it on to the IC manufacturers, and they will actually create it for them. So this is really important to understand. So companies like Intel will design its own chip and manufacture it. The fabless companies like AMD and Nvidia will design it and will ask the foundry models companies to actually make it for them. And the foundry companies have literally don't really have their own product. All they do is, based on these designs, they will basically create it for them. They will manufacture it. And that is basically really important to understand. So what sometimes tends to happen is you get some companies like, obviously Intel has been the biggest company in the world for a very long time because they design it and manufacture their own chips. Whereas these companies were relying on third parties or other companies to actually create it for them. So now what is happening is some of these companies are coming together. So the fab is called fabless foundry model. So where they will team up. So the fabless companies will team up their foundry company, and they become like a partnership. So they will create it and design it and everything basically by themselves. So in essence, they become the IDM models, if you like. So recently there have been like a little bit war between these companies. So there's a company called ARM, which is a UK based company, or ARM, and they are currently, in the process, basically Nvidia is currently in the process of buying that company. But a lot of these other companies that don't want this to happen is actually going against it and saying this is not right. So they go into the government and saying this is monopoly, this is not good, because they know Nvidia has a lot of money, a lot of power, and if they end up, because right now they're fabless, so they might become a fabless foundry model because they putting the 2 companies together. So they also have a team of companies on their side as well. So that's quite interesting to see what's going on with that sort of a thing at the moment. But it's really important to understand how these companies operate and in what markets, because you can't compare like for like. So you can't say Qualcomm is the same as Intel, for example, because they do different things. One focuses on 5G and things like that and mobile phone applications, and whereas the other one is more of the computers and so on, even though they actually do touch a bit of mobile phones. But at the same time, it's more to do with the iPads and all that stuff instead of just the actual phones. So yeah, so you really need to understand the difference between these companies. I found this research, but I'll share that with you guys if you want to. But the most important part for you is to understand what these companies do, whether they are fabless company, a foundry company, or the IDM companies. Once you understand the concept, then you can start comparing it. So let's have a look at the first company that we will be looking at today. So the idea was just to kind of give you the backdrop, then give you these companies, and then obviously you're going to do your own research and find out and see if these companies are worth your money. And the first company we're looking at is Broadcom. Broadcom is one of the companies I own in my portfolio. On 2020, their revenue was $25.5 billion. The reason I've added this part here is I want you to see, I want to compare it so you know exactly how big these companies are and how much revenue they generate. So $25.5 billion of revenue last year. Obviously, this company focuses a lot of the mobile phones and things like that. So they work with Apple, they work with Motorola, IBM and Dell and a million other companies. So they are obviously a fabless company. So they don't actually create it, they design it themselves. The stock's currently trading $480 per share. They've got PE ratio of 44, which is very high at the moment. They've got market $191 billion market cap. They've got amazing dividend of 3%, which is unheard of in the technology sector. They've got basically raised that 50% in the last 5 years. They've basically, so their CAGR is actually 50%, which is amazing. Then you've got dividend growth of 10 years. The payout is very low, 52, which is excellent. Their dividend safety, for whatever reason, is 67, according to Simply Safe Dividend. And they've got about $12.7 billion in free cash. So they've got a lot more money basically to cover that, and obviously use that to diversify the portfolios and buy other companies. And they've been doing that in the last few years as well. So this company has got a long way to go. You can see the 52-week high has been $303 per share. Right now it went up about 495 and then it's gone down a little bit. So it's currently trading for 480. And when you look at the beta, actually not bad. So less than 1, profit margin of 19, return on equity about 20. We look about 15 or more, which is basically what we need. And currently the company is overvalued according to Simply Wall Street. And according to Morningstar, it's actually 3 stars. 3 stars basically means it's fair value, okay? And they are saying the fair value for this company is 400. So 400, but at the moment it's 480. So it's slightly, even though it's fair valued, it's slightly overvalued at the moment. So maybe if it goes below 400, then maybe it's a good time to add if you've already got one. If you haven't got one, maybe start a new position, whatever. Again, this is not advice. I'm just literally, when I talk about these things, sometimes I'm almost talking to myself. Okay, so 480 per share, but they're saying it's about 400. So it might be a good, if it drops below 400, it might be a good time to start or add to your stocks that you've already got. And according to Yahoo Finance, is a buy at the moment. Right, so the next company is Taiwan Semiconductor. This company is a foundry company, and let me show you why I absolutely love this company. Right, so if we go and have a look at this, this is basically the foundry companies out there in the world, all of them put together, including Samsung. Now, they have 54% of the market share. So Taiwan Semiconductor is the company everyone goes to when they want their chips to be created. So all the fabless companies, they will design, then they will give it to TSMC and say, design it for us. So 54% of the market share. That's huge. This is one of the reasons why I absolutely love this company, because of the monopoly they have. Obviously, other companies like Intel and whatever, they exist and they're doing their own thing. They're not relying on basically TSMC. But when you look at how many companies out there that are creating their own chips, but they don't actually know how to make them, they design them, so they use them. The AMDs and Nvidias and all of these companies are actually customers for this company. So let's have a look at a bit more information. So if you look at their companies that they actually work with, the products they create, so the Apple products from the Max Air to the iPhone 12 has a chip created by or designed and created by TSMC. Okay, even though Apple is kind of trying to diversify and they started now becoming almost like a fabless company. So they design it, they gave it to Taiwan Semiconductor. So recently they used to use obviously Intel, and then they basically cut that deal off. But now what they do is they design their own and then they give it to the foundry companies like TSMC. Right now stocks trading $120 per share. PE slightly high, 32. Even though it's high, I'll show you why a lot of people are saying this company is actually undervalued at the moment. They have a market cap of $536 billion, annual dividend of 1.5, so it's actually moderate, that's okay. 11% growth for the last 5 years, and obviously they've done this for about 10 years. The payout ratio is quite low, 48. Then you've got dividend safety of 62, and they've got $9.8 billion of free cash flow that they can use for whatever you want to use it for. The stock went up as high as $142 per share, and as you can see right now it's 120, so it's got a long way to go if it goes back to that side. It's slightly volatile, and then you've got the profit margin of 38, almost 39%, and 39, almost to 30% of return on equity. Is undervalued at the moment, and according to both Simply Wall Street and Morningstar actually says it's 4 stars, which means it's really cheap. Okay, let me show you. It's really cheap, and basically the fair value for this stock should be $133, and right now it's $120 per share, and it's a buy according to Yahoo Finance. So this is one of the companies that I own. I think I've got about 10 shares. I'm planning to add more next week, so we'll see how that goes. So the next company we're going to look at, and again, the reason I'm doing this is not because it's cheap, okay, is but the fact it's one of the biggest, it's not the biggest manufacturer or the foundry companies when it comes to chip making. And the other thing as well I wanted to quickly show you is if you look at the news, for example, in the last couple of weeks and the months, for example, the chip shortage will basically says here will likely get worse before it gets actually better. And this has been on for a long time. The shortage is actually real. A lot of companies, including some of the car manufacturers, actually can't produce cars because, or they produce it but they're waiting for the chips to arrive, and because there's a massive shortage. And if you look at some of the news that came out, I think it was Intel, basically the CEO of Intel was saying recently, the next 10 years will be great for the industry. Okay, not just for his company, for the whole industry. So as you can see, there's the companies there that, like this type of companies, that will potentially go up in value. I don't know what's going to happen, obviously, but I'm just betting on the fact that inshallah we will pay off. And it's a great company. They do pay dividend. They're very stable. The stock's not that expensive at the moment. Okay, and according to a lot of the analysts that I do trust are actually saying, obviously sometimes you have to be careful, but 133, you can't go wrong. I've been buying this company since it was I think it was 110 or something like that. So I'm actually making it a bit still in the red, because I start buying it first when it was 140s, and then start buying more when it was 120. So I kind of averaged it down. So I'm waiting maybe another pullback hopefully in the next couple of weeks, but I'm definitely will be adding to it next week. Right, so the next company we're going to look at is Qualcomm. Qualcomm is basically involved in the 5G side of things. Okay, it basically works basically software for vehicles, watch, laptops, Wi-Fi, smartphones, and other devices. So they are again a fabless company. So they design these things and then pass it on to the manufacturers like TSMC, and they produce it for them. So it's currently trading $141 per share. PE is very low. This is probably one of the lowest in the semiconductor sector. $152 billion company, nice dividend of 2%, 6% growth for the last 5 years, and then 18, basically they've been doing this for about 18 years. Payout ratio 30, almost at 35%. Okay, not bad. 80% dividend safety, and they've got about almost $8 billion in the bank to actually pay off anything they need to pay off and pay us dividend and so on. The stock went up to $167 per share, and it was as down as $86 per share. So you can see right now where it is kind of in between there. So I think this has got a lot more upside to this company in the next few weeks. Slightly volatile. Profit margin is about 27%, and then you've got 153%, which I wasn't sure what was going on here, but apparently it is. Return on equity is 153%. And currently is undervalued both. So fair valued for Morningstar, and it's $136 per share. That's what they're saying. It's currently trading at 141, so it's slightly gone up from where they think, but according to Simply Wall Street, is actually undervalued. So I have already shares and I'm planning to add to it, but if you start in a new, maybe you might have to think about and maybe wait for the dip or something. I don't know. It's completely, entirely up to you, but I will normally go in between what these two companies are saying. So the fair value for, in fact, let me quickly check. Right, I just wanted to check basically according to Simply Wall Street what they are saying. So the fair value for the stock is 98. Okay, so even though, wait a second, what is going on here? This is not, yeah, sorry about that. That was the wrong stock. So they currently saying is 168. So their fair value according to this, okay, and they currently trading 141, but 168 is what they think it should be, whereas these guys are saying their fair value is 136. So again, actually not bad, not, well, yeah, about $30 difference, I think. So again, you kind of need to go to the maybe in the middle and just wait for a drop. That's entirely up to you, but that's what I think anyway. Yahoo Finance, it's a buy on Yahoo Finance. Right, so the next company we're going to look at is Nvidia. Now, this is one of the biggest and the best companies out there. And if you look at, let me quickly show you before I actually move on. So the revenue for TSMC was $45.5 billion. Revenue for Qualcomm was 39, sorry. And then you've got 19. So it's probably one of the lowest when it comes to revenue side of things, because this company is still growing. One of their biggest, very well-known GPU that they actually create is the GeForce. A lot of mining companies, or like Bitcoin mining and gaming and all that stuff, actually use their product. It's been up massively in the last few weeks, and just literally this year, I think it went up almost 80%. And one of the reasons for this is this news that I've come across the other day, where basically they're doing a split. So when companies do a split, it basically makes no difference to us as investors. Okay, you're still paying the same amount, you still own the same shares, but your one share becomes 4 shares. So what? It makes no difference, right? But a lot of people actually fail for that kind of hype and start buying the company because they think they will get more for their money. That's not the truth. Okay, and that's one of the reasons I think this company has gone kind of shot up in the last few weeks. But let's have a look at anyway. So they are a fabulous company, currently trading $802 per share. About PE is 95, probably one of the highest in that sector. Market cap almost $480 billion. Dividend, it might not, to be honest with you, I don't even know why they pay dividend, because it's almost non-existent, but it's okay. It's very tiny, but it's there at least. The payout ratio only 4% of their income, and then they've got a dividend safety of 89. You might as well make that 100%, because I'm not sure why, because it's very, very low, isn't it? And then you've got free cash flow of 5.5. 52-week range. Actually, this is incorrect because it's gone up now to 800 per share. And beta is slightly volatile, so it's above 1. That means it can fluctuate literally, and I've seen this happen. It can literally change to 2-3% every single day. Profit margin of 27 or almost 28%, and then return on equity 33%. Overviewed, according to Simply Wall Street, is 81.2% overvalued, and according to Morningstar, the fair value should be about $550, and right now people are paying $800 per share for this company. That's absolutely insane. With this type of PE ratio, that will take you almost 95 years to get basically to break even or to get your money back. And this is the kind of thing I want us to be really, really careful, because yes, it's a great company. It has a massive potential ahead of itself. If they actually buy the ARM company as well, they will grow massively, and they will probably become a $1 trillion company, sooner or later. But the thing is, does that mean you will pay for this kind of values? No, because you're never going to get your money back. You're never going to make a massive profit. And at the moment, it's a hold. If you own it, it's a hold. If you own it, to be honest with you, and you bought it when it was 400, whatever, I will say sell it, unless you're not basically you're a long-term investor and you don't want to sell it. So the final company that we're going to look at is Intel. Right, so Intel, there's a lot of news out there. People are saying they're dead, they this, they that. but they, like we said before, they are IDM company. They design it and manufacture their own thing. They've now actually started a new basically a factory in America. They're spending about $20 billion just to do that. They've got a new CEO, things like, changing. Again, I don't know, and to be honest with you, I don't own the stock at the moment. I've looked into it for a while, but I do definitely prefer TMS at the moment, TSMC at the moment, because not only do they basically have 50% of the market share, they also have one of the biggest companies as their clients. So again, that I'm happy with that, and I want to keep that. So let's have a look at the details of the company. Share price is very low, $56 per share. They've got PE very, very low, market cap of $224 billion. So they are definitely the biggest, have always been the biggest, and they've been around for hundreds of years. So they're by far one of the best companies out there. But right now, there's basically a question mark about their future. So I don't know what's going to happen. I don't know in the next few weeks or months or years to come. But I think this is probably one of the best companies, undervalued at the moment in this stock market. Annual dividend of almost 2.5%, 6% growth in the last 5 years, dividend growth 7 years in a row, payout ratio only 30%. And look at this, right? So dividend safety is about 68, but look at this, almost 20 billion or $19 billion in the bank to do whatever they want to do. They're doing it now, creating building an own factory. They are obviously trying to make sure the company goes back to where it belongs and where it was, because every single computer that you use that has some sort of an Intel chip, that's where they want to be. That's what they want to continue doing. So we'll see what happens. So it's gone up to $68 per share not long ago, but it's back down again. Very, very beta wise is very not volatile at all. Profit margin of 24%, return on equity of almost 24% as well. Right now is overvalued almost 43% according to Simply Wall Street, and then fair valued when it comes to Morningstar, and it's about $65 per share. So what they're saying is the price should be about $65 per share at the moment, but when you look at it, it's on basically $10 off where it should be, and it's a buy. Now, if you're looking for a company that is basically, if you want to take a bet, if you know what I mean, and you think this company, because of the amount of customers they have and the amount of cash they have and the market share they've got, I wouldn't bet against this company coming back and becoming one of the best, okay, if not the best in the next few years. But I'm not really, I don't want to put my money on it, okay. I prefer this company, and I'm going to keep investing in this company instead of basically going with Intel at the moment. So overall, I hope you've learned something from this, because my main point was just to give you an overview of what is available, what these companies actually do, and what some of the best companies out there at the moment, just to kind of show you what is going on. If I show you my portfolio, I do own TSM there, I do own Broadcom, and I do own Qualcomm as well. So I've got 3 out of the 5 companies that I showed you at the moment. Okay, I've invested quite a bit of my money. So let me show you there we go. So the Broadcom, I've got almost £1,700, and then I've also got the Qualcomm about £1,000, and then TSM I've got about 800 something, but I'm definitely adding to it. Like I said before, I'm slightly down because I was buying when it was 140, but I'm going to add to it in the next few weeks. While I'm waiting the company to come back, I'm still collecting that £10 or £11 in dividends, and then just continue. Again, Broadcom is actually one of the best when it comes, because they're basically dividends almost yield is almost 3%, over 3%. So they really pays a very, very good dividend, and I think this company has a massive future ahead of itself. But the only thing is right now is overvalued, so I wouldn't actually buy anything yet. Anyway, I hope you enjoyed the video. I hope you enjoyed the transparency. I hope you learned something. If you did, please like, subscribe. Let me know if you have any questions. Thank you very much. Assalamu Alaikum.